I'm Mark Draper from GEM Capital. Today we've got an update on the European debt crisis, which for those who've been following us for some time have highlighted three key areas that they've got to get on top of with this crisis, and they are recapitalising the banks, keeping interest rates affordable, particularly for countries like Italy and Spain, and at the same time allowing politicians to reform their economies to make them sustainable in the areas of tax, welfare, spending and things like the labour market. There's been a couple of big announcements recently which we think are changing the course of the European debt crisis. The first is the enablement of the European Stability Mechanism, which will come into operation in the second half of this year. This has got access to €500 billion of funding, and what its purpose is to provide money to recapitalise European banks, including $100 billion for the Spanish banking system, which is apparently more than enough. The official estimate came in at €60 billion to recapitalise the Spanish banking system. Its other purpose is to go into the bond market to buy European bonds for governments that require assistance. The second announcement came from the European Central Bank, or the ECB, and they've come out recently and said that they'll do whatever it takes to keep the Eurozone together, and Mario Draghi went on record saying, believe me, it will be enough. And what they've announced is an unlimited program to buy government bonds of countries that ask for assistance. So why is that important? The reason that's important is because what it does is provide a guaranteed market or a guaranteed buyer in the market of European bonds. And what that does will provide confidence of those who are buying bonds in the market that they're going to get their money back because they've got the ECB behind it. Ultimately what that means is that the interest rates that investors are going to ask on those bonds is going to be lower than if the ECB weren't behind those bond programs. Or in other words, what it's going to do is reduce the borrowing rates for countries like Italy and Spain. And that's already evident in the bond market. So if you were to have a look at the 5-year Italian bond market, it's dropped from about 7.5% late last year to now about 3.7%. And the 10-year Spanish bond rate has come back, well, the government borrowing rate has come back from 7.6 to about 5.6%. They are big drops in interest rates, and it's the equivalent of dropping interest rates by, say, 3% on a home loan borrower in Australia. It makes a big difference to your ability to be able to not only service the loan but save a lot of money on interest costs. Now, the European Stability Mechanism and the ECB alone can't fix this crisis, but the important part of what's going on right now is that it's going to buy or allow enough time and keep borrowing rates affordable for long enough so that the politicians can go in and do their job in Europe, which is to reform their economies in the areas that we mentioned before on tax, spending, welfare and the labour market. So we see these developments as very, very positive for the European, for the Eurozone, and we would go so far as to argue that it's actually a turning point in the way that Europeans are dealing with the debt crisis. It's not over yet, but these are really concrete building blocks that we think will go a fair way toward resolving the European debt crisis. For more information, check out our website. We'll be providing regular updates here, or give us a call.